Welcome to the deep dive. Today's mission is a really deep technical look behind the curtain of lending technology. We're pulling insights straight from a recent investor Q&A.
Yeah.
And our goal is to understand the inner workings of modern AI, specifically how it handles these massive, just chaotic, real-world economic shocks.
Things like sudden policy changes?
Exactly. And, what really drives growth when the whole macro climate is just relentlessly tough.
Well, we're synthesizing some pretty complex discussions here. Things like dynamic model calibration, risk management, and strategic market positioning.
And for you, the listener, this isn't just about, better algorithms.
No, not at all. This is about seeing how a tech company can differentiate itself by achieving faster, less biased, and more statistically rigorous adaptation to market volatility.
So we're going to walk through that amazing concrete example of the student loan policy shifts. It's the perfect stress test for any system.
It really is.
And then we'll zoom out to the big strategic picture of scaling volume in a high-interest, high-risk world. It all comes down to speed and the ability to find, statistical significance in all that chaos.
It's a fascinating window into how financial services are being rebuilt, brick by analytical brick.
Okay, so let's unpack this key challenge right out of the gate. How does an advanced AI model react when the governing rules of a massive economic segment just, suddenly change?
And the sources gave us the perfect real-world example, that student loan policy whiplash.
An absolute whiplash.
That shift was a monumental test. We went from a period of, nearly 4 years of forbearance,
right,
meaning non-payment didn't result in any penalty or credit report damage. So the models effectively saw payments just stop.
And then almost overnight.
Then you flip to mandatory repayment,
Mm-hmm.
and you've got the threat of delinquency jumps and even wage garnishments looming. That's a huge external non-financial shock.
Applied to 40-something million borrowers. So if you're a traditional lender using ARD models, you might just assume, the economy's fine, but student loan borrowers are going to default more now.
And you'd apply a blanket risk increase.
At the blanket increase, right.
And that's where the core design philosophy of this system really shines. The models are built as a fully general solution.
Meaning
Meaning they don't rely on specific, established, human-defined relationships between macro variables. It doesn't just assume that a headline about unemployment must cause a certain level of defaults.
So the model isn't preloaded with assumptions like, if interest rates go up, everyone defaults.
No, it waits.
It waits for the data to confirm it.
Exactly. It's built to be agnostic. And the mechanism it uses to handle these unexpected shocks is really insightful. It uses time as a core feature.
Time as a feature. Okay, that's a key concept to grasp. How does that translate into actually identifying who is suddenly risky?
Well, the model dynamically interacts time, say, the behavior in the last 30 days, with the thousands of borrower characteristics it observes.
So everything it knows about them.
Everything. Their specific industry of employment, their income, whether they had student loans, and critically, whether they were actively paying those loans before the forbearance started.
So instead of reacting to the headline student loans resume, the model is looking for pockets of actual observed distress among its users after that date.
Precisely. If the policy change causes financial distress, the model is smart enough to isolate the specific segment of borrowers who are impacted.
For instance,
Maybe it sees that government employees who stopped paying during forbearance are now disproportionately defaulting on their personal loans. The model observes that specific behavioral change right after the policy date.
it's like finding a needle in a haystack of economic data. But the needle is only visible because it started moving on a specific day.
That's a perfect analogy. And the key insight is that if this behavioral change is statistically significant,
Within that isolated group.
yes, within that group,
Yep.
then that new behavior is dynamically incorporated as a new risk factor and priced in immediately.
And if nothing happens,
If they make a major policy announcement and nothing statistically significant happens to the borrower behavior on the platform, the model does nothing. It doesn't panic.
that dynamic, non-judgmental response sounds critical for high-volume lending. And to give our listeners some context on the magnitude of this particular risk, what did the sources say about the borrower pool size?
Yeah, they gave some useful numbers to ground the discussion. About 35% of the overall borrower base has a student loan, federal or otherwise.
Okay, about a third.
But of that 35%, only about 2 to 3% are currently what they call non-current.
So delinquent.
Right, delinquent.
Yeah.
This shows that the risk is real, But relative to the size of the total portfolio, it's a manageable, isolated adjustment. It's not a systemic collapse.
That helps size the challenge. But this leads to the next natural question. If the machines are so good at handling these micro shifts, are they always running the show, or is there a human overlay?
There is absolutely an ability for human intervention, but the sources indicate it's highly targeted and generally not focused on micro-level borrower decisions.
So where does the human judgment prove superior to the AI?
It comes in two places, and they're both strategic. First, there's what you could call preemptive intervention.
Okay.
If the magnitude of a potential risk is huge, let's say a major global trade war is declared or a massive bank failure occurs, and there is a strong, compelling thesis to be concerned.
Even without immediate data?
Even without feedback data, yes.
Okay.
The models can be instructed to price more conservatively, but in the aggregate.
So it's like setting the thermostat, as we've said before. The AI handles the daily temperature swings, but the human risk committee can enforce a lower temperature for the whole building if they see a storm approaching.
That's a much stronger analogy.
Okay.
And when a risk magnitude is small, what they refer to as in the noise of the macro.
Like the student loan example.
Right. And
Right.
there's no strong high-level thesis one way or the other. The machines are just left to handle it dynamically.
And how often do humans step in to say, the model is wrong about this specific type of borrower?
Very rarely, almost never at that micro level. The sources are pretty clear. Human intuition is consistently found to be inferior to the models when dealing with individual borrower pricing.
But there is still intervention.
Oh yeah, consistent human intervention at the macro level. The models are constantly told to be slightly more conservative in the aggregate, regardless of what they think the macro conditions might be.
It's a foundational safety factor.
Exactly. It's built in to ensure the loans overperform even in good times.
That's a brilliant structure. You let the AI handle the complex, real-time micro shifts, while the humans enforce a conservative macro floor. It's like guardrails for the entire system. Okay, now let's pivot from capability to constraint. If the technology is this advanced, this adaptable, why are originations today running at roughly half the peak volume they hit previously?
Now this is where it gets really interesting.
It connects the tech to the high-rate economy we're all living in.
It really does. And it raises an important question about market constraints versus the underlying technological capability. The reason volume is limited today is, well, it's entirely due to pricing factors imposed by the external environment.
And they identified two primary reasons for that.
Yes. Two reasons why the consumer price for a loan is significantly higher, which limits who gets approved.
Factor one is clearly the riskiness of the consumer right now.
Absolutely. Consumers are still at a significantly higher risk level than they were pre-pandemic. Their internal measure, the Upstart Macro Index, is sitting around 1.49.
Let's quickly define that for the listener. What does 1.49 mean in plain English?
So if the index were 1.0, that would mean default rates are expected to be exactly in line with the historical average.
Okay.
At 1.49, it means defaults are expected to be 49% higher than that long-term average.
Wow, 49%.
It's a massive increase. And that projected risk must be priced into every loan, making them more expensive.
That's a huge headwind. What about factor two, the investor side?
Credit investors and lenders are also demanding higher returns to participate in this market. They now expect returns several hundred basis points higher than they did during the zero interest rate environment of previous years.
So several hundred basis points means investors want, what, 2%, 3%, or even more return on their money than a few years ago?
Correct. So you put those two factors together, higher consumer risk and a higher required investor return, and the outcome is unavoidable.
Fewer people get approved.
Or those who are approved pay substantially higher rates.
Hmm.
It's the market mechanism functioning correctly.
But they aren't just sitting around waiting for the macro index to drop back to 1.0, are they? Or for interest rates to plummet to hit peak volumes again?
No, and that's the key point. That would be relying on external forces to drive growth.
So what's the internal driver?
It is, and always has been, model improvements leading directly to conversion improvements. They have smarter models, more automation, more product separation now than they had at the previous volume peak.
The tech has to beat the economy.
That's the idea. They expect to scale rapidly through continuous technological advancements, proving the loans are safer, and through the growth of new product categories, not through waiting for a macro correction.
Which brings us to the strategic architecture. Why invest so heavily in building a public-facing brand and a marketplace?
Instead of just being an invisible software provider.
Yeah, a white label AI that banks just license. It seems simpler.
It seems simpler, but it's a foundational strategic choice about value creation and, frankly, survival in the AI race.
How so?
Well, waiting for traditional lenders to adopt a technology that requires enormous scale and rapid iteration to get better is just inherently inefficient and painfully slow.
So if your core product needs constant, high-volume data to learn and improve, relying on the slow adoption cycle of traditional finance sounds like a technological death sentence.
It is. By owning the customer relationship, by attracting consumers directly and controlling that entire marketplace, the platform gets to move faster and control its own learning environment.
The models that learn the fastest are going to win.
That's the race. And the marketplace generates the volume and the high-quality relationship data needed for that rapid learning.
So customer acquisition isn't just a cost center. It's a vital part of the competitive advantage.
Absolutely. They acquire consumers more efficiently than others, and as the models improve and approval rates go up, that acquisition efficiency gets even better. It creates a powerful, reinforcing loop.
And there's a clear consumer promise that comes with that public brand.
The stated goal is explicit: to tell every American consumer, come here first. You will get the best offer, the best process, guaranteed.
You can't make that promise as an invisible component.
They argue you can't. That kind of powerful promise, that confidence in the result, cannot be delivered if you're just tucked away inside a bank's website.
And we hit the constraint of tradition here, which is why the marketplace approach is existentially necessary.
Yes. The sources were very direct. Traditional banks are often only comfortable adopting what one of the executives called the 2015 version of the technology.
That's a brutal assessment.
It is. But if you constrain the pace of your technology rollout to match the willingness of these institutions to adopt, that would be death to a high-growth, AI-first strategy. You have to move at the speed of the AI, not the speed of the banking committee.
And that marketplace structure also lets them aggregate capital from various sources, leading to higher approval rates and serving a wider variety of credit needs, which just reinforces that brand.
It's all connected.
Speaking of new products, let's look at rolling out adjacent categories like revolving credit. That's a fundamentally different product structure than a fixed-rate personal loan. How easy is it for the AI to pivot?
They're currently experimenting with revolving products, but specific commercial launch details are pretty limited.
But the core tech should be adaptable, right?
Highly in. While the underlying AI techniques are highly extensible, the math, the architecture, it all works for any credit product. The limiting factor for any new product is always one thing:
Training data.
training data. It's the fuel the AI needs to prove its differentiation. It can't just run on theory.
So new products follow a pretty distinct rollout pattern.
They do. They start small, they are initially not very differentiated, and they take time to accumulate what they call a quantum of trading data.
And once that threshold is hit,
Then the new product category hits significant unlocks. They can apply all the proven analytical wins from the existing personal loan set, and importantly, using their own balance sheet helps accelerate that early data gathering.
let's connect this back to operational efficiency. We hear about the promise of 100% automation in loan processing. Where are the current limits?
The platform is not, and likely never will be, 100% automated. About 10% of applications require a human review.
And that 10% exists primarily to stop.
Bad actors, fraud. The system lacks sufficient confidence that certain complex or ambiguous pieces of information are legitimate, or that the person isn't malicious.
Why is human review still superior in that 10% of cases?
Because fraud is fundamentally defined by intent. And intent is one of the hardest things for a purely pattern-based AI to model effectively.
So the algorithms can spot suspicious patterns.
But they can't definitively judge malice. The goal is to set the confidence threshold high enough to prevent massive fraud losses, even if that means inadvertently stopping some perfectly good borrowers who are then approved after a human gets involved.
So that 10% is the cost of securing the system.
Against constant malicious attackers, yes.
That clarity helps. Finally, let's talk about customer acquisition cost, or CAC. When the unit economics are strong, should they try to drive that cost down to zero?
The strategy is clear on this. The goal is not to drive CAC down when unit economics are strong, which they confirm they are today.
So what do they do instead?
They prefer to pour that value into growth. They focus on maintaining solid margins and profitability, then use the extra efficiency to reach out to more customers and conquer more market share.
Rather than just maximizing the profit on every single loan.
Exactly. They're optimizing for scale and profit over just minimum cost. And if we connect all this back to the bigger picture, what stands out is the operational commitment to letting the AI react dynamically to external macro shifts, like the student loan policies.
Using data, not human assumptions.
Right. Using data to price risk. This unique agility, which is powered by their own marketplace data loop, is really the core engine for their future scaling ambition.
So what does this all mean for you, the listener? We've seen that in high-volume, information-rich fields like lending, the competitive advantage doesn't simply go to the smarter model.
No, it goes to the model that can ingest, learn from, and price for statistical changes in real time without human bias, faster than anyone else.
That speed of adaptation is the product.
It is the product.
And that brings us to our final provocative thought. Consider the speed of technological adoption in the market. If, as the sources suggest, the traditional financial industry is generally only comfortable adopting the 2015 version of this technology, how wide will the performance and efficiency gap grow over the next 5 years, given the exponential pace of AI innovation we've discussed today?
That is something to mull over.
That's something to mull over until our next deep dive.